Today on InvestTalk, we look at the problems in the commercial real estate market and whether this caller's son should take his profits on Nvidia.
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk, and welcome to the second half of the year. The third quarter has begun. Today was the first trading day of the first quarter, and did I say first quarter? First trading to the third quarter. And I'm Justin Klein. I'm here to help you through the back half of this year and beyond. First half is in the books. It went by fast, just like they all do as you get older. And it was an interesting year. We entered the interesting first half of the year. We entered the second half with a lot of, obviously, political news. You have the we have the holiday coming up here on Thursday. And there's a lot to unpack as we now start really that final stretch of until the election. Markets do tend to get more volatile as you get closer to the election. And we're just, 4 months away, roughly, a little more. So as we've seen with the first half of this year, 6 months go by fast and 4 months will go by even faster. So all of this will be at least a near-term influence on markets. And our job is to give you some historical context and unpack it in an unbiased way. It's so easy to get caught up in the politics of it all. But the reality is, market doesn't care about your politics, doesn't care about my politics. It cares about the facts on the ground. And so we will be here to help you navigate these times. And we do that by answering your finance and investment questions. And in a minute, we're going to run down the show topics for today, as well as the market performance. But as usual, we'll tackle our first caller question now. It's a live call, and it's Art in Menlo Park. And Art, you have a real estate question?
Yes, Justin. How are you? Thanks for taking my call.
Of course, anytime. Thanks for making it.
Yeah, I purchased a piece of property probably about 10 or 12 years ago with my ex-girlfriend. Mm-hmm. And we ended up, she ended up moving out of mm-hmm. state, and mm-hmm. I stayed in the property. Mm-hmm. And then I eventually refinanced, mm-hmm. but I didn't keep her name on it.
Okay.
I just wondered, can she still get her portion of the sale of, I guess there's like a $250,000 exemption, if I'm correct.
Yes.
And I wanted to give her her share.
Okay. I believe, I honestly don't know the answer to this. This is more of a real estate lawyer question, actually more of a tax question, something for a CPA.
Yeah, that's what I thought.
Right? I know you each get $250,000, but I'm not sure if that applies if you are you both on the title?
Not anymore.
Not anymore. But and how did she get off of that title? She just sign it off?
She was initially, but I refied, so now she's not.
And she signed off on being off the title?
Yes.
Interesting.
But
okay.
She trusts me.
There you go. Well, that's good. At least you it ended amicably. I would honestly talk to a CPA on this. That's a very good question. I'm not sure what now. The rule is on the $250,000 exemption is you have to live in it in 2 of the last 5 years as your primary residence, and doesn't sound like she has at any point in the last 5 years lived there. Correct?
Correct.
So she probably
so
doesn't.
She doesn't.
Yeah, she probably would not qualify, even if she was on the deed, etc. To qualify for that, you have to have lived in the property as your primary residence in 2 of the last 5 years. So you can move out and rent it for a couple of years, but it has to be sold within that 5-year period, and you have to have lived in it as your primary residence for 2. So, yeah, I would talk to a CPA still, but I doubt that she's going to qualify for that exemption.
Okay. Thanks a lot, Jeff.
No problem. Thanks for the call. I do have my real estate license, so I know a good amount about real estate, but I don't, the tax questions, they can get squirrely. There's always these weird exemptions that happen, and it's always important. And I say this all the time. It's good to have a smart CPA. They're more expensive than filing through TurboTax. But honestly, a good CPA is probably going to save you a lot more. That's going to cost you. And then you get in situations like this, and you have someone good to turn to. I know we have some locally that we refer our clients to, but it's a lot of people pinch pennies that way. And I think in more cases than not, unless you're just super simple, you're super young, you just have a W-2, you might be a renter, you don't have kids, etc. You could do it probably through TurboTax. But once your life gets a little more complicated, usually a good CPA is worth their cost. Now we're going into a short break. On the other side, I will tackle your finance and investment questions. But please remember, you can call anytime and leave your question on the InvestTalk voice bank at 888-99-CHART.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
Now, we have a lot of ground to cover over the next 45 minutes or so, and if we have time, we'll cover all of these topics. Our main focus point is about the CRE crisis, commercial real estate, and how banks are unloading a lot of these office loans. The commercial real estate market is in turmoil as banks rush to sell off billions in office loans. So we'll dive deep into the unfolding CRE crisis, examining its causes and potential consequences for the broader economy and the sector. Okay. We also have other topics on the docket. We obviously had the debate last week, and we know that there are calls for President Biden to bow out of the race. I think we'll know more about that in the next week or so. I put the odds right now right about 50-50, but we shall see. But what will be more important is, at least for markets, will be what will the policies do for the dollar? Okay, because currency movements oftentimes have large impacts on asset categories as well as subsectors. For example, obviously a weaker dollar is good for domestic industrial base. It's good for commodity markets, energy markets, etc. Strong dollar tends to means lower economic growth. It tends to mean more strength in the tech sector because markets are looking for growth. And so movements in the dollar will be vital to understanding the trends in markets post the election. So we'll look at what each one will mean for the future of the dollar. Also, private REITs. There's more news, BREIT, Blackstone REIT, and how they started to gate redemptions. Well, there's more now. Starwood Capital as well, and we'll look at that. And then lastly, digging into Nvidia's 10Q. If you don't know what 10Q is, it's a quarterly disclosure. And that disclosure, often, a lot of investors don't read it. It can unveil some potential shenanigans, shall we say? And is Nvidia engaged in some shenanigans to overinflate their revenues, for example? Okay, so we'll look at that if we have time. Okay, so that's what's on the docket for me. We also have your topics as well. Voice bank questions on municipal bonds, as well as mid and large cap stocks. And also, we have questions submitted via the comment section on the YouTube channel. And of course, we welcome your finance and investment questions live at 888-99-CHART. Now, let's pivot over to one of those questions submitted via the comment section over on our YouTube channel. Rowdy1234567 love it, says, curious what you think of AbbVie. I am bearish on the company because the earnings are really manipulated amongst other negative things I see within the company's financials. I have been selling naked calls for a while with $150 strike price because this is what I think the company is worth, sub 150. Well, I think this is a very interesting question because it strikes on two things. One, accounting shenanigans. You talked about that. I haven't, frankly, looked deep enough at AbbVie to say that there aren't. But what I will say, if you dig into some of the surface level numbers, you can see cash flow is strong. Okay, cash flow is strong, and usually it's hard to fudge cash flow. So I don't know if I'd go that far. Now, they do have a lot of debt. AbbVie does have a lot of debt on its balance sheet. But that debt has been coming down actually pretty dramatically. So how are they paying that debt down if there are a lot of, misgivings about the financials? Because in the end of 2022, they had $17 billion in long-term debt. Now it's only $8 billion. So they paid down over $10 billion in debt over the past just couple of years. Pretty good cash flow, $22 billion on a $300 billion market cap. Solid free cash flow yield. So I don't know where you're seeing that, but I think overall the company is fine. I don't love it, but it's not really trading at an egregious price. Earnings are expected to be going up this year and next year, 1% and 7%, not a big number, but that's why it's trading, at a mid-teens multiple. So I wouldn't be aggressively going this route. And also, naked call writing is very, very risky. And that's the second point here, is that it's a different way of quote unquote shorting the stock, but your upside is capped. Your upside's capped. When you're selling options, upside is capped. And so it's at 170 now. It's obviously in the money. But if this, say, goes to 300, you could be in a lot of pain. And where's that upside, right? So I don't know if this is the best way to play it. Now, the good thing is you don't have to pay that dividend. Remember, if you're short a stock, you have to pay the dividend that it's paid. So 3.64% now. That's another, upside of using options. But I'm not sure where you see those shenanigans. And I'd find other names to short, especially a name that would be in a longer-term downtrend. I'd rather short those names than something that's in a longer-term uptrend with a dividend like AbbVie. Thanks for the call. Now let's take a look at the market today. It was a fairly mixed day overall, but mostly down. You had broad large caps were up, and that was because you had some of the EV names up. Tesla was up about 6%, Rivian up 6%, NIO up 7%. That was really the strength in markets. AMD was down 2%. Nvidia was roughly flat. Apple up about 2.5% here. And that's how we enter the second half of this year. We still are waiting on a big jobs number on Friday. We have the holiday on Thursday. So it'll be kind of a shortened week, even though we have the big economic news on Friday. Volume will probably be pretty light. Usually the first half of July tends to be fairly bullish. So I will say that. But we are in a situation where rates are going higher on the back of an increased chance of a Trump administration, which would be based on his policy, is likely to be inflationary, and that could cause problems in markets. The MOVE index is rising, and I think risk is rising in markets as well. Now we're moving into a break. Still to come, more of your questions and my main focus point, so hang on. Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors. Go to Chris in Maine looking at Powell Industries. You own it or looking to buy it?
Hey, Justin. Yeah, I opened a small position in Powell in the 160s. I was pretty happy with that when it jumped up to 220 or so, and now it's back down into the 140s. So I was thinking about actually picking up a decent-sized position here. I know it's got a little bit of a spotty up and down earnings history and a pretty large short interest. So I was, some concerns there, but the industry and its overall kind of trend seems pretty positive. So I want to see what you thought of it.
Yeah, it does have a shoddy history of profitability, but it's doing well right now. And I think that is the worry, is that that's just right now. Typically these companies that historically have low profitability and then suddenly go through a short-term boost in profits, that tends to be a flash in the pan. And earnings expectations for this year, and especially next year, are for that to flatten out and start to go down. So it's supposed to be $9.20 this year, which would make it cheap at $143 per share. You're talking about a 15 times multiple. But if growth slows and even reverses, then this is drastically overvalued. And this is a pretty big move. You're talking about 31% drop from its high. That is a large reversal on volume. So I would be very careful here. The market's going to speak to you. I would have an out.
Mm-hmm.
That out, honestly, would be the low from April, which is around $120, which is also the 200-day moving average. If you break below 120, then I would just move on. I think that that would be a clear signal that the market is telling you that this is a flash in the pan. It will not be producing this level of earnings and cash flow over a sustained period. So you always want to have risk parameters here. And once again, the market will speak to you. It's already pulled back from over 200 to 143 today. If it drops below 120 on a weekly close, I would use a weekly close below 120, I'd be gone.
Mm-hmm.
And it would be the signal that the market to you that this is probably headed back towards that $1 to $2 in earnings range.
All right. Well, thanks for your advice.
No problem. Thanks for the call. Now, our main focus point is about commercial real estate. Commercial real estate has been something everyone's been worried about for a while. And while it's important to follow these stories, it's also important not to get too hyperbolic about it. There are very few things that happen in markets that have dramatic, wide-ranging ramifications. Yet, most people read headlines and they jump to a million conclusions, and that it will unravel a whole industry, it will cause a panic in markets or a major sell-off, etc. And the reality is the vast majority of news events are idiosyncratic. They're one-offs. And they don't really create a sustained problem within, once again, the broader market or a particular industry. And commercial real estate is one that, at least now, is being talked about as a potential for a catalyst for a broader economic problem. And I don't want to rule that out, and I think you have to consider that. But once again, it's about understanding probabilities. And the probability is that this is a problem, but it's a problem that can be dealt with. Now, regional banks, mostly, where most of the exposure is, they're setting aside a lot of reserves for potential losses. And it's not just office, it's multifamily as well. And this is frankly where I think the biggest issue in real estate for the average person really is. And that's in rentals. There's a lot of people that own rental properties. They manage rental properties. They've seen a boost in rents. But there's also been a boom in multifamily supply, new supply coming on market. This year's the biggest on record. And so multifamily loans are also not performing quite as well. And so while office loans are the main biggest pain point, multifamily also in big cities mainly, they are struggling as well. Now what's interesting is it's not actually the banks that are performing the worst. It's the loans that are packaged up and sold that are seeing the biggest delinquencies. Commercial mortgage-backed securities, 4% delinquency rate versus the ones that are owned by regional banks, 1.2%. So the bond funds that you have, those are the ones you actually have to be worried about more than the actual banks. Now, regional banks own 44% of their balance sheet are in these CRE loans versus only 13% for the large banks. So that's why the regional banks have the most exposure and the most risk here, second to those bond funds that you might be holding in your account. Now we're heading into a break. I'm ready to take your calls now at 888-99-CHART. On the next Invest Talk, we'll look into the story behind this headline, Trump versus Biden, how each will impact U.S. sectors. The 2024 U.S. presidential election outcome could significantly affect various sectors of the stock market. There are potential implications for investors under a Trump or Biden presidency, especially in industries like clean energy, infrastructure, financials, and more. So we'll talk about that story tomorrow, but for now, we will head over to Dan in Walnut Creek, and he wants to talk about Nvidia.
Hey there, Justin. How you doing today?
Good.
Good. Hey, so I've got a brokerage relationship with Merrill Edge, and when my son wasn't able to invest on his own, I was investing for him. Some money he would slide to me, and I would invest it. He bought Nvidia. I can't remember what he bought it at, but he bought 8 shares, and now it's 80 shares. He's up 850%.
Nice.
And he's in his 30s, so I think he's willing to hold it long term. But what do you think? I guess the answer would probably be different if he's a short-term investor versus long-term. But what do you think about if he should take some profits from Nvidia or not?
I would absolutely take profits from Nvidia. Think of Nvidia; it's at or near the largest company in the world. And when you compare when it comes to market cap, it's trading at egregious valuations, and that's not taking into account that a lot of their sales. If you look at their 10Q, they're pretty dubious. There is likely some financial shenanigans going on behind the scenes, and what's the upside here? Is it going to go up another 800% in the short term, medium term? Probably not. Okay. And technically, it looks like it has topped back. What was that, last week before last? So, I think it's it's a great winner, but definitely time to take some chips off the table. Now, do you sell all of it? It's up to you guys, but there's obviously some tax consequences to think about. But I would certainly be more apt to sell some or all than hold it.
Okay, great. Well, thanks very much for the help. We appreciate it.
No problem. Thanks for the call. Let's go to James in New York, looking at CVE, which is Cenovus Energy.
Yeah, I was noticing that there seems to be a high call volume on that stock, particularly in the month of August. I was wondering what that might mean for a company of this size, like pre-earnings, what that might mean if there's a high call volume before a company is about to go earnings, or in a case of Cenovus?
That just means that there's a lot of speculators that are trying to position for a move into earnings. That's not uncommon. It's actually very common. Where somebody or some entity is trying to play, if it's a call, right, the upside of a move going into earnings. That's not odd.
And would that be a bullish sentiment in that case?
Yeah, I mean, if the implied volatility, that is a measurement of what the market is pricing in for potential volatility of an event will be. If that is higher on calls than it is on puts, then yeah, that would be the market betting. They're paying up for that bullish outcome. And that typically is bullish. But you have to look at it compared to the puts, right? Because there's going to be those that are betting on calls as well as puts, right? Betting both ways. And, like I said, you have to compare the two. What is the implied volatility with a similar percentage out of the money, right? 5% up, 5% down, for example. And are those implied volatilities the same? Right, this stock is right around $20 per share. So you want to look at maybe the 21 strikes as well as the 19 strikes, right? The 21 calls and the 19 puts, and see which one has the highest volatility, implied volatility. And so the one that does have the highest implied volatility, that's where more money is typically flowing to bet on a particular outcome. Make sense?
Yes, yeah, I'm with you on that.
All right. Thanks for the call. Great question. No problem. Yeah, earnings announcements, it's very common for speculators to go in and try to lever up on a particular outcome. Maybe it's, they know something about the industry that the broader market doesn't. That's always a big question. And they could be, gaming the difference in market expectations versus reality. Okay. And so, that's how investors tend to use the option market to play those earnings announcements. Okay. Thanks for the call. Let's go to, what are we going to talk about next? Talk a little bit about, the dollar. The dollar and let's say a Trump presidency, or let's just say a Democratic presidency continuation. I still think it's about 50-50 that Biden will drop out of the race after last week, but we shall see. But either way, you want to be ready for a Trump, once again, or a Democrat remaining in the White House. And the policy mix that will come with those second terms, shall we say. And you really have to look at the policies to understand where the dollar will likely go. So right now, we have a very loose fiscal situation, right? Government spending a lot of money, and the Fed has tightened rates, okay? And what has happened since? Well, the dollar has rallied. And that's what the textbooks would predict. A mix of loose fiscal policy and tight monetary policy makes for a strong currency. That's textbook 101 economics. Why is that? Because typically loose fiscal policy means good economy. Money going out there into the economy, more dollars, and you get good economic growth compared to, say, other countries that aren't spending as much money. Okay. Now that can only last for so long. Remember, if you're in a deficit, you're borrowing from the future and bringing that growth here forward. Okay. And then when it comes to interest rates, if you have a tight monetary policy situation, meaning interest rates going up, well, the relative difference between interest rates here and the rest of the world is higher. Think of us in Japan, right? Though the yen is falling, continues to fall, mainly because our rates stay high and they're still stuck at zero, even though they're no longer negative. There's a massive differential there. And the only way for Japan to solve that is to raise rates and close that differential. Okay, so that's how policy manifests in currency moves. Okay, so what if you have a Biden administration? Well, it's clear that they probably won't spend as much, and interest rates might come down a little, but generally that gap between the interest rates will stay relatively wide in the rest of the world. And while our economy is weakening now, general spending and fiscal authorities are likely to remain very loose. Now, what about a Trump administration? Very similar, I would say, except for it's been clear that the Trump administration would probably put pressure on the Fed to lower rates. He likes low rates. He did that before, right? So he has no problem spending money, widening out the deficit. He's already talked about, right, cutting taxes completely and doing all tariffs, and that would be also dollar positive. Okay? If you have a lot of tariffs, it means that spending would go towards more domestic goods. When you take dollars and you go buy foreign goods, you're selling those dollars and you're getting that foreign currency, right? If we buy something from Japan, we need to sell our dollars to get yen to buy something from them. If those deficits go up, well, it's not deficits, those tariffs go up, then we will be, those products will be more expensive and we will look inward. So that would be dollar bullish. And once again, Trump would spend just probably on different things, just like he did in his first administration. However, he's talked about a weak dollar. A weak dollar would be better for building out the domestic industrial base and making us more competitive. And there's a lot of rumors that his advisors are plotting to create a weaker dollar. They saw, during his first administration, the dollar strength as an offset to his policy platform. And they might be committed to preventing that from happening again. Now, as I said with tariffs, if you have tariffs, that's naturally going to be dollar positive. So I don't know what they don't get about that. They should know that. Okay. So what I would say is, I think a continuation of a Democrat White House would be dollar positive. But I think Trump overall would be more dollar negative because of them, wanting to get our domestic manufacturing base more competitive, as well as pressure on the Fed to keep rates lower and close that differential. So we'll see. I think it would be wildly inflationary if Trump's policy prescriptions for a second administration come true. But we'll see. We'll see if what he says will come to fruition. Now let's dip back into the InvestTalk voice bank for a question that came in earlier.
Hello, Justin and Luke. I had a question about the Schwab U.S. Small Cap ETF. The ticker symbol is S as in Sam, C as in Charlie, H as in Harry, A as in Apple. I have had this stock since September of 2021. I bought it at $49.83. Since 2021, I've been down on this for quite some time, and I'm just wondering if I should either get rid of it or trim my current position. So it's about 7% of my portfolio, and it is the only small cap ETF I have. So just please let me know what you think, and I'll listen in. Thank you.
All right, this is SCHA, the Schwab US small cap ETF. And 7% of your portfolio in small caps, that's it. You sound relatively young. I have no issue with that. Now, small caps have underperformed as of late because its market's become, even more top heavy than it was just a couple of years ago. So I wouldn't panic, frankly. I think it's a fine allocation. This fund is fine, 4 basis points in its fee. It's a blend between value and growth. So it has a little bit of both on the exposure side. I wouldn't be thrown off by the recent underperformance because long term, small caps tend to outperform. Right now we're in a top heavy market that'll likely change over time. So I would stick with SCHA. Now here's another question that came in from our InvestTalk YouTube channel. Selena Marie says, I own a partial position in SU. What are your thoughts on this company and what is a good entry point? Looking at Suncor SU, this is a Canadian company engaged in oil and gas exploration, refining and marketing of oil sands and natural gas in Canada. One of the larger Canadian energy names out there, talking about a market cap of about $50 billion. And if I remember correctly, yes. I'm just trying to remember if this is the one. Yeah, okay, this is a fairly pure play. Yeah, so this would be a large cap way, a safer way to play the Canadian oil markets. Let's just say that. A safer way. Now, don't get confused with safe. I just say safer compared to, it's other companies within the space that tend to be smaller, in the, call it $3 to $10 billion market cap. There's a lot of those kind of smaller oil, Canadian oil plays. This one's more diversified, larger, etc. Been around longer. I have no problem with it. 4.2% dividend yield. Relative strength is pretty good, 81. Pretty solid. And earnings are expected to fall 21% this year, but still trading about a 9 times forward-looking earnings. That's fine. I have no problem with it. I would have no issue adding to it after its recent pullback. Thanks for the call. This is Invest Talk. I'm Justin Klein, and we have one goal each and every weekday, and that's to help you achieve your own version of financial freedom. And our work continues after this final break. So get your questions in now at 888-99-CHART.
The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the Invest Talk podcast. Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions.
Hey, Justin and Luke, Matt from South Florida. Question about municipal bond mutual funds. Looking at a couple that have certainly had a pretty decent run over the last 20, 30 years. One is NEA, Nancy Edward Alpha, and the other is MYI, Michael Yellow India. Trying to figure out for someone looking to buy these in a taxable fund and hold them, 6, 7, 8 years, because we plan to be in one of the top 2 tax brackets for the foreseeable future. I guess talk me off the ledge. Why shouldn't one of these 2 be at least 10%, 15, maybe even 20% of our portfolio? They certainly have a history. I think one of them is 20 years, one of them is 30 years, providing pretty consistent yield, federally tax-free, and they certainly look attractive. Maybe an alternative would be a corporate bond fund. I don't know, but certainly these 2 look pretty good where they're at, and maybe even Luke, with your background, love to hear what you think about making this a fairly substantial part of a taxable portfolio. Thanks again.
All right, looking at MYI and NEA, these are 2 municipal closed-end bond funds. And the first issue I usually have with the bond funds is that they are levered. Most of these closed-end bond funds have leverage to them. And that's why when bonds fell dramatically starting in late 2021, these went down considerably. So MYI fell from about $15 per share to a low recently of $9 per share. 15 to 9. That's in a bond fund. It's supposed to be safe. Now, you do get a yield, so some yield is offset. But net, you're probably down at least 30% over the last 2 years. And why is that? Well, it's because of duration. The vast majority of, NEAs, look at NEA, because they're both, I believe, pretty similar, are over 10 years. 10%, 10 to 15 years is 10% of the portfolio. 15 to 20 is 21% of the portfolio. 50% is 20 to 30 years. And 5% is over 30 years. So you're talking about 85% of this portfolio has a maturity date of over 10 years. This would be a long-term bond fund. Long-term. And we've said before, if you have a lot of duration risk in this market, in an inflationary environment, you are going to have problems. And guess what? MYI is just as bad. It's actually worse. And because of that leverage, over 100% of this is long-term. So when I say it's pretty easy to talk you off the ledge, because just look at the performance since interest rates started to go up. Now, you could argue, hey, that was a flash in the pan. We're going to go back to low interest rates and low inflation again. And you're not going to get that sell-off in bond market again. I disagree. I think we are in a secular bear market in bonds. Duration assets are generally not going to do well. And these are levered duration assets. I don't want that. If you were looking to buy municipal bonds because you're in the highest tax bracket, now that's good that you said in the top 2, hopefully the highest, because really municipal bonds only make sense if you're in the highest tax bracket. Okay. So if that's the case, municipal bonds are fine, but what you want are short duration assets, short duration bonds. This is long duration. This is all long duration. This is not where you want to be. So while the yield looks enticing, 6 to 7% tax-free, you can see with the duration risk that you take, you are subject to massive losses to the likes of 20, 30, 40%. If you agree with me, this is not where you want to be. If you disagree with me, then, take that duration risk. But I'd advise against it. Thanks for the call. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.